Hi, good afternoon, everyone. Welcome to the Fixed Income Analysts, Inc., or FIAZI's fourth Women in Fixed Income Conference. I'm Monica Agarwal, President of FIAZI and Head of U.S. Retail and Consumer Corporates at Fitch Ratings. As we kick off 2022, we're excited to have highly regarded senior female leaders who will share their outlook and perspectives on the global fixed income markets. We cannot think of a better set of panelists to have this conversation with, and I welcome each and every one of you. I'm also delighted to report that we have close to 1,000 participants registered for the conference, building on the success of our Women in Fixed Income event in late 2020. For those of you that are new to FIAZI, the organization was founded in 1975 to promote diverse views and thought leadership through a highly regarded speaker series and networking events. We would like to thank Joyce Chang, Chair of Global Research at JP Morgan, and our honoree at the 2014 Hall of Fame for being an important partner to FIAZI and champion for our Women in Fixed Income events. Joyce, we truly value your support and guidance. We would also like to thank our sustaining members, CreditSights, Fitch Ratings, Moody's, and S&P Global Ratings for sponsoring today's event. Finally, I would like to acknowledge Ralph de Cisar, our program chair, and Lauren Nauser, our executive director, for their tireless efforts in putting this event together. Now, just a quick note before we get started. For members of the press that are on the call, any direct quotes must be cleared by the speakers. And now onto our program. We're absolutely honored and thrilled to have Barbara Novick, co-founder and former vice chairman of BlackRock and current senior advisor, join us today to share her views on the future of asset management. Barbara has been a pioneer in leading the structural transformation of the asset management industry with the rise of passive investment and the development of the ETF market. Since its founding in 1988, BlackRock has become the world's largest money manager with assets under management closing in around $10 trillion. From its founding until 2008, Barbara headed the global client group and oversaw business development, marketing, and client service across various asset classes for institutional and individual investors worldwide. Barbara established a global public policy group at BlackRock in 2009 to provide a voice for investors, and her views and expertise are sought after by policymakers and regulators. This is particularly true during times of crisis, as evidenced with her work with regulators when the pandemic shook the markets in early 2020. Barbara has since published numerous reports outlining lessons from COVID-19. Barbara currently serves on the board of 100 Women in Finance, an organization focused on empowering and promoting women in the global finance industry that many of us are members of. She also serves on the Peterson Institute for International Economics Board, Center for Financial Stability Advisory Board, Committee on Capital Markets Regulation, and the Milstein Center for Global Markets and Corporate Ownership Advisory Board. We're absolutely delighted to have her share her insights from her career with us today. Thank you so much, Barbara, for joining us. And without further ado, please welcome Barbara Novick.
Good afternoon or evening, depending on where you are calling from. I wanted to start, I was asked to say a little bit about myself. I began my career in 1982 and recently retired as vice chair of BlackRock. Over 40 years, as you just heard, I've worn a number of different hats, including product development, clients, and public policy. Now I'm going to do something that I wouldn't normally do, but the sun has decided to shift from when we set up. So 1 second. That will probably make this less distracting for you. Thank you to Joyce for inviting me and Monica for that lovely introduction. You have a great event planned today and very timely given what's happening in the markets and with Fed policy and of course with Chairman Powell testifying just yesterday. My comments will explore the future of asset management with a focus on development specifically in fixed income. So let's start by looking at where we are and where we've been. The first and most obvious observation is the low level of interest rates, along with the increasing concerns about inflation. We've been told we can't use the word transitory anymore. What began as a response to the great financial crisis over a decade ago has remained a fact of life much, much longer than anyone could have expected, with COVID scrambling the ability of central banks to move towards normalization. And why do investors care about rates? Lots of reasons, but number one is low rates have implications for all investors, whether you're a pension fund, an insurer, a sovereign wealth fund, a foundation, endowment, even individuals. You simply can't earn enough on traditional fixed income instruments to meet your liabilities. As you know, money market funds are hovering just over 0%, even with fee waivers. The 10-year Treasury is yielding less than 2%, even with the recent backup in rates. So given the inflation concerns, talk has shifted from the Fed simply reducing monthly bond purchases to actually pivoting from QE to now we have a new term, QT, quantitative tightening. And we heard yesterday the Fed is very likely to start implementing rate increases, multiple rate increases, perhaps as soon as the first quarter. All of this as expectations of inflation are well above the Fed's 2% flexible average inflation targeting. Even if inflation decelerates in 2002, we expect the rate will still be too high. Today's release of CPI showed a 7% annualized rate, which frankly we haven't seen since just before I began working in the industry 40 years ago. The key question for market participants is how is this going to impact treasuries as well as broader fixed income and non-fixed income markets, which I'm going to leave for the following panels to answer. One of the outcomes of this low rate environment is a shift of investors' portfolios towards private credit, where investors can earn a premium. To put this in perspective, the private debt market grew from $575 billion in 2016 to over $875 billion by the end of 2020. Private debt includes US and European direct lending, distressed debt, mezzanine debt, special situations, and venture lending. The fastest growing subsector is the direct lending, accounting for over 40% of the capital raised in recent years. Likewise, special situation loans were boosted by pandemic dislocations. As investors search for yield, growth is poised to continue. Private debt market is expected to increase by more than 10% annually to almost $1.5 trillion over the next several years. Some of this will be from diversifying into different regions and new subsectors. For example, there is strong growth potential in Asia, which could become as large as the US and Europe direct lending markets combined. As I'll discuss later, you can expect ESG features will be incorporated into the main product types, as well as grow as a private credit subclass of its own. The next big consideration is the importance of diversification and how best to achieve it. ETFs have exploded in popularity. Between 2010 and 2021, ETFs grew from $1.5 trillion to over $9 trillion. The recent rate of growth in fixed income ETFs has been even more spectacular, growing nearly 9 times in assets, from just $200 billion in 2010, that's not so long ago, to over $1.7 trillion in 2021. It's helpful to understand what's driving this growth. In short, ETFs have shown that they provide intraday liquidity, exchange trading, price discovery, and transparency. And that's to bond markets that we all know are generally bilateral, opaque, and discontinuously liquid. We saw these factors at work during March 2020, commonly called the COVID crisis, with ETFs adding much needed liquidity to somewhat frozen bond markets. Even the Fed included ETF purchases as a way to buy fixed income assets without singling out individual credits. And over the past 2 years, an ever broader group of investors is participating in this market, which provides strong winds for growth in the future. ETFs are just one example of the lessons we learned from COVID. While it's worth spending time on what we learned and how policymakers are responding, I don't think any of you want me to go on all night. So for those who want to explore in more depth, I recommend reading the Viewpoint series that we wrote in 2020, as well as the recent report by the Financial Stability Board. Let me touch on just a few highlights. It's evident that the US Treasury market would benefit from some reforms. During March 2020, the dash for cash was global, as investors sold US Treasuries and other high-quality liquid assets to meet liquidity demands. Simultaneously, banks stepped back from making markets. I agree with many of the reform recommendations put forward by the G30 Working Group on Treasury market liquidity, as well as the Interagency Working Group for Treasury market surveillance. Some of these expanded central clearing, more all-to-all trading, and increased transparency can make the Treasury market more robust. COVID-19 also highlighted the weakness in short-term market structure. As investors and issuers worldwide chased liquidity simultaneously, short-term funding markets largely froze. Holders of high-quality commercial paper struggled at times to find any bid from dealers in the secondary market. While it's important to address vulnerabilities in money market funds, policies must also address short-term market structure. Just as with treasuries, we need to explore market solutions that don't rely on bank balance sheets, especially if banks are likely to step back from market making during times of stress. Critically, money market fund rules should be redesigned to ensure that cash buffers are available to use rather than creating bright lines that trigger withdrawals. The recent FSB final report on money market fund resilience provides a relatively holistic view and acknowledges important jurisdictional differences. This applies to money market fund structures, experience during the crisis, and regulation that caused some reforms, such as swing pricing, not to be universally applicable. Another area of focus coming out of COVID has been liquidity related to open-end funds. BlackRock's analysis indicated that while fund redemptions were elevated during March 2020, the vast majority of funds performed well. They managed a robust process, an ex-ante approach to liquidity risk management, and a variety of liquidity risk management tools. In jurisdictions where it was available, swing pricing was a useful tool on open-end funds in reducing liquidity mismatches and addressing first mover advantage, as acknowledged in the FSB report. We encourage further adoption of swing pricing or other anti-dilution tools where possible. Why are we so keen on swing pricing? Simply, swing pricing has a fairness element where you place the transaction costs on the transacting investors. It also has a financial stability benefit by discouraging first mover behavior by eliminating any advantage. A discussion on lessons from COVID would not be complete without touching on CCPs and margin requirements. During March 2020, rapid changes in initial margin, or IM, particularly for futures contracts, created a need for larger amounts of collateral and put significant pressure on already stressed markets. To put this in perspective, IM required for exchange-traded contracts by CFTC-regulated US CCPs increased nearly 50% in March, 50%, resulting in a record amount of customer margin held at these CCPs. A series of regulators, I'm going to give you some alphabet soup, but BCBS, CPMI, and IOSCO are working jointly. They've issued a consultative report. They're looking for feedback on issues such as transparency and the responsiveness of centrally cleared IM models to market stresses. You should expect to see some changes come out of this process. And any of you who saw today's obituary for LIBOR, while changes to LIBOR, that was in the New York Times, while changes to LIBOR emanated from the great financial crisis rather than the COVID crisis, policy decisions even 10 years later are impacting the markets today. This transition impacts trillions of dollars of securities, derivatives, and loans. LIBOR has officially ended for new contracts as of year end. While most US LIBOR tenors will still be available through mid-2023, they can only be used for appropriate legacy contracts. And here in the US, work is ongoing to allow tough legacy contracts that will be outstanding beyond 2023 to transition smoothly away from LIBOR. New York State signed legislation in April. The House passed some federal legislation in December. The Senate is expected or hoped to move legislation forward soon. And as you know, we need both the House and the Senate to send something to the president for his signature. SOFR has been identified as the risk-free benchmark to replace LIBOR in the US, and many people have moved to that. In addition, credit-sensitive rates such as Ameribor and BSBY have been introduced to address specific market needs such as bank loans. A recent survey by the International Financial Law Review indicated that an overwhelming majority of respondents would be using credit-sensitive rates for some part of their business. AFX, which sponsors Ameribor, has 229 members representing 184 banks with over $5 trillion in aggregate US bank deposits, plus 45 non-banks. And importantly, the Ameribor rate contains a dynamic credit sensitivity, which is a component of LIBOR that just isn't captured by SOFR. Not surprisingly, regional banks and community banks see this as an alternative to LIBOR for making loans that reflects their real borrowing costs. As we look ahead, sustainability is a major trend throughout asset management, and fixed income portfolios are certainly not exempt. Let me quickly define a couple of terms. Use of proceeds bonds are instruments to support the Sustainable Development Goals, or SDGs, as laid out by the UN. Green bonds are a subset that began in 2007. In green bonds, the proceeds will be exclusively applied towards new and existing green projects. Today, green bonds account for about 78% of the green, social, and sustainability bonds. They're growing at least 20% year over year since 2017, with over 1.2 trillion outstanding today. And green bonds are increasingly becoming more mainstream. Governments have embraced them. Sovereign wealth funds have issued over 175 billion. Emerging market green bonds are an area for growth. We've seen South Korea, Chile, and Hong Kong create new programs. But one of the biggest challenges in this area is the proliferation of taxonomies and the introduction of multiple indices. Global alignment is needed as criteria on activities covered, as well as varying documentation, is fragmenting this market, which is at a crucial stage. A direct impact can be seen in the exclusion of sovereign wealth fund bonds from the EU taxonomy. Governments are also embracing other types of use of proceeds bonds. Just this year alone, or I should say last year, governments including Chile, Mexico, and the European Union sold over 10 billion of social bonds. Chile's social bond raised 1.6 billion of this, with proceeds going to address poverty, health, education, and other social issues. Likewise, the US municipal bond market has embraced social criteria. 2 minority-owned underwriters partnered with several investment firms, and they've developed and distributed a questionnaire that addresses everything from policing policies, efforts to combat race-based inequality, and social services. Lastly, I'd like to address the ongoing impact of technology. A critical development has been fixed income electronification. Over the past decade, electronic trading in fixed income has evolved from a nascent to a much more mature area. Some of the key features: increasing reliance on automation, dealers introducing new proprietary trading platforms, electronic trading platforms such as Market Access and TradeWeb broadening their offerings to meet demand, and new platforms emerging. Collectively, this has improved pre-trade price transparency, liquidity, and efficiency across the fixed income markets. As electronification of fixed income markets continues to grow, straight-through processing will be supported across fixed income products, which will improve efficiency even more, reduce errors, and help streamline reconciliations. Regulation will need to reflect these developments and should be tailored to make sure the benefits are retained. ETFs, which I discussed earlier, are a key component of these market structure improvements. The growth of fixed income ETFs and other index exposures has resulted in the need to price and trade large numbers of bonds simultaneously, driving the rise of algorithmic bond pricing and further adoption of electronic trading and alternative bond trading architectures. Another interesting area to watch is blockchain. Obviously, cryptocurrencies are an important use case that we should keep an eye on. This technology also holds promise for advances in settlement architecture and other operational processes. Finally, we need to recognize the growing regulatory requirements, whether pre-trade or post-trade. This is where RegTech or regulatory technology can be deployed to enhance risk management and compliance functions. So in conclusion, change is the only constant both in markets and in asset management. When we started BlackRock, Solomon Broad Investment Grade, or Big Index, which some of you may never have even heard of, was ubiquitous. ETFs didn't exist. ESG was not yet an acronym, and technology was incredibly basic, which is why we built Aladdin. But that's a story for another time. Fixed income markets have come a long way, but market-driven opportunities and regulatory reform will drive evolution in the years to come. If I can leave you with 4 key takeaways. First, the COVID market volatility showed us that reforms are needed in short-term funding markets, as well as in the US Treasury market structure. This is an area of significant focus for regulators, academics, and the industry, and it couldn't be more important. Second would be, given the proven benefits of fixed income ETFs, we can expect to see continued growth in this product as more investors embrace it. Third, the growing investor demand for ESG products will drive continued expansion of offerings like green bonds and social impact bonds. And fourth, technology. Technology is everywhere. It's had a dramatic impact on market structure, on transparency, on operations, on really every aspect of what we do throughout our lives. While today's bond markets are not your grandmother's bond markets, our granddaughters are going to be saying the same thing in just a few years. So again, if I can thank Joyce for inviting me, I really appreciate the opportunity to share these views.
Thank you, Barbara, so much for sharing your experiences and observations with us and giving us all things to think about as we embark on what we are all hoping will be a transformative year. In the second part of today's presentation, we're going to have 2 panel discussions, both focused on what we could see in the years ahead in the markets in 2022. And we're pleased to have women who are leaders in their fields join us today. Our first discussion will be led by Lale Topcuoglu, Head of Credit at Swiss Re, who will discuss the domestic market outlook with Winnie, Cisar, Global Head of Strategy at CreditSights, and Priya, Misra, Head of Global Rates Research at TD Securities. Our second panel will tackle the outlook for international markets with a discussion from Joyce Chang, Chair of Global Research at JP Morgan, Cathy Hepworth, Head of Emerging Market Debt at PGIM, and Janet Henry, Global Chief Economist at HSBC. Thank you all for your time and thoughts today. Lale, I'll hand it to you.
Perfect. Thank you, Erin. Thank you, everyone. Thank you for taking the time to join us for this debate, and I'm quite looking forward to it. I'm part of Swiss Re. I help us manage the global credit markets, but my second job, which I feel quite passionate, is actually I'm one of the ambassadors for diversity and inclusion for the asset management. So if anybody out there that's in the audience that is actively involved, look me up, hit me up, let's compare and exchange some ideas, and let's keep moving us forward along the diversity and inclusion journey. Before we start the panel, Priya and Winnie, if you can just take 2 seconds and please introduce yourselves, and then we'll get into the Q&A.
Sure, I can start. Thank you, Lale. Thanks everyone for joining in. I'm Priya Misra. I run Global Rates Research at TD. I've been following the government bond markets now for a very long time. I was at Lehman, or I started my career at Lehman Brothers, doing essentially the same thing. So you might wonder, I haven't quite figured out where the 10 years is still going to be. And then I was at Bank of America Merrill Lynch. And at TD, I am part of a couple of affinity groups, the Women Leadership Group, as well as Minorities in Leadership. Thanks.
Hi, everyone. Thank you for joining us this afternoon. And I'm so excited to be a part of this great panel of women. My name is Winnie, Cisar. As Erin mentioned, I am the Global Head of Strategy for CreditSights. My primary focus is on the US markets, so investment grade, high yield, and leveraged loans to an extent. I recently joined CreditSights in September of last year. Prior to that, I had been Wells Fargo for the entirety of my career in a number of different capacities, most recently as the head of credit strategy there, but I've also spent time in investment banking and high yield research on the high yield trading desk, and then helped to build out the leveraged finance strategy effort for Wells. When I was at Wells, I was one of the co-heads of the Women Go Far initiative, which was the corporate and investment banking women's groups efforts, and we always tried to be allies to our other affinity networks as well. And as I continue to navigate my new company and our new parent company of Fitch Ratings, I will definitely be trying to get more involved on those efforts as well.
Perfect. Thank you both. So quite a January start. Not only the emergence of COVID, but a little bit of volatility here in the treasury markets. So let's start with the elephant in the room, right? So Priya, I'm going to start with you. Let's talk a little bit about the Fed. Will they, won't they, will they raise, will they not? You know, we all wait for the dots. The dots come out after the meetings. We all try to figure out who's where, whose dot is where. It's like, you know, sorting through Valentine's cards and trying to guess like who actually gave you a card. And then Chairman Powell gets on the call and he says, well, try not to pay attention to the dots. So what are you thinking as we go into the Fed meeting? You feel confident that the first rate hike is coming out in March? Or is there even a possibility we may get a dovish twist right here in Q1?
Great question, and it has been volatile. In the words of Chair Powell from yesterday, I think it's useful for all of us to know, and the Fed is saying they have to be humble and nimble. And as a rate strategist, it was very clear in the last month as we changed our forecast twice, partly in response to the dots. So I'm glad you brought that up. I mean, the Fed may try and tell us not to look at the dots, but it is a communication tool. And it is a sign from the Fed in terms of, you know, number of hikes, start of the hiking cycle, the terminal rate, which is very important. If you mind the 10-year, maybe it doesn't matter whether they start in March or May, but where do they end up? How much higher are they going beyond that neutral rate? So the dots are an important communication tool. And so we changed our call actually when the dots came out and we realized, wow, the divided Fed, if you look at the dots in March or June or September last year, it reflected a divided Fed. There was the team transitory and the team persistent. And there was one team in the December meeting. And I think there was a little bit of a communication misstep, I would say, between that September and December dot plot, where it wasn't clear to the market, which is why the dots was such a big shocker, that the Fed had given up on the transitory concept of inflation. And I think the minutes made it even more clear. So I would say that as important as the dots are, and I'm sure the market will move with the next set of dots, every Fed message, so Fed speak, minutes, certainly testimonies, speeches, all of that is going to guide the market, because the treasury market's all about the economic outlook and then the Fed reaction function and how they perceive the outlook. And it's clear from recent Fed speeches, which came out in that dots, but also in the minutes. The minutes were far more hawkish than even what the dots suggested, which is why the market reacted as much last week. And we changed our forecast again. So you asked about the near-term forecast. So we are looking for the Fed to start hiking in March. I think even though Omicron is a downward impact on service demand, we think it's temporary. And I think the Fed is so concerned about inflation, and Omicron adds more upside to inflation, I think, which is why the Fed doesn't probably want to wait. So we do think they start liftoff in March. They hike 3 times this year. And what was clear, I mean, we were debating whether balance sheet runoff in 22 or 23, and Chair Powell suggested later this year. So I think they're telling us that they want to start the process of normalization. And so this year is going to be, I think, this delicate balancing act between the Fed telling us they want to start to normalize, the market pricing in the normalization, and then how do financial assets or the economy respond? And then that'll drive how much more can they go. Now, we've got a baseline view based on our economics view that they can go 4 times next year. And then that's the end of the hiking cycle. So we've got a 2% terminal rate, sort of a gradual pace, no 50 basis point hike. But this is where it's going to be very dependent on the data. So yeah, I think they've given up on the idea that there is a lot more labor market slack. I think they think slack is largely gone, which is why they want to start that normalization as soon as possible.
3.5% unemployment rate is pretty darn good. All right, so obviously, Winnie, the credit markets, the rates, is a big factor for us. We think about it. So how do you think about, the Fed rate hikes? At one point, you would sort of throw up your hands in the air and say, "Ooh, this is getting too much. It's just too negative." Can you talk us through your thoughts?
Sure. So this has been a really tough one to figure out, in no small part because the Fed has shifted its messaging so significantly. And it's really given a lot of credit investors pause, because all-in yields across the US fixed income markets are still just so low. But offsetting that is the reality that there's just a lot of cash that still needs to be invested in something. And if you're sitting in cash right now, you're effectively losing money on a day-to-day basis because of these inflationary pressures. And so you're walking this kind of fine line of, I need to manage my cash and also come to the reality and the realization that we have a much more hawkish message from the Fed right now. Now, we've been a little bit skeptical that the Fed is going to be able to embark on this kind of long-term tightening cycle, because by midway through this year, you do have some base effects kicking in. Inflation should be a little bit less eye-popping in theory. And as we continue to see broader economies at least adapt to the next phase of COVID and the pandemic, that should help offset some of the inflationary supply chain pressures and things like that. And so then you kind of come back down to credit fundamentals and thinking about, okay, I realize that valuations don't feel particularly compelling, but I do have cash that needs to be put to work. And you have to figure out where are the sectors and issuers that are going to benefit from this inflationary environment. Are defaults going to be ultra low because we do have a fairly optimistic outlook for growth, or are we just really tightening into a new credit cycle and going to see the turnover? And it's kind of exciting to be a credit strategist again, because all of those questions are what ultimately makes markets. And so our conviction has been to continue to prefer that credit risk over duration and really kind of follow the Fed. And if they're saying that they're going to tighten, at least anticipate the financial markets are going to react to that messaging and then try and figure out later on, what is the reality of the extent and magnitude of that tightening, and what impact will that have ultimately on the credit markets, which we think will be a little bit more benign than what markets are currently pricing in.
Excellent. Well, let's carry on that subject. So the balance sheet. It's, the mention of it last couple of weeks has really thrown off the market. Clearly the QT, everybody assumed it would be a 2023 problem, perhaps. Suddenly it's now in 2022. Now it's a little bit interesting because obviously the balance sheet has gone from 4 trillion to 8 in the last 2 years. We're talking about reducing the balance sheet, but I believe if you looked at the federal balance sheet today, I think it's still increasing. So it's a little odd that we're talking about reducing while it's still going up. But I have so many questions on this topic because it feels like a lot of balls in the air, and I would love to get your perspective on, Priya, how you're thinking about it. To me, there's obviously the timing on the runoff, right? I think the most aggressive assumption on the sell side I've seen is June. But then the question around, well, will they actively sell investments? How do they deal with the reinvestments? Do the reinvestments go into treasuries? And is there a way they can sort of manage the reinvestment on the treasuries where they can sort of control that terminal rate, right? Control the yield curve. And perhaps I'm giving them way too much credit in terms of how magical they can be. But would love to get your thoughts on how do you see all this different parts playing out?
So it's natural you have all these questions because there's a lot with that balance sheet. And depending on how they actually undertake it, it's going to have pretty big market implications, front end of the curve, long end, treasuries, mortgages. Now, I will say that the Fed has given us very little so far in terms of, we know they started the discussion, that's all. We also know, and the reason why I think this year is going to be volatile is they told us that we can't look at the last time playbook as closely. And I think it's true. Balance sheet runoff took 12 months to phase in last time. We think it's going to be a 6-month phase in. The balance sheet itself is much shorter weighted average maturity, so much more runs off. So there are big differences in the balance sheet. There's a very big difference in terms of inflation outlook. So they seem to be under more urgency to undertake it. But a lot of these details haven't yet been ironed out, which is why I think June is still early. That would mean that literally in the next few meetings, or they have 2 meetings, that they need to communicate the plan. Because what they did last time, I think that still holds. They're going to communicate the plan well before they actually do it. So we think they'll give the plan out by mid-year. June, July is when they communicate the plan. They actually start in September. Now, our base case is that the caps, they'll do it in a very similar treasury and mortgage caps. They'll be phased in, but over 6 months. And you'll end up with caps closer to 90. We have 90 billion. 60 billion in treasuries per month will be allowed to run off once you fully phased in. So you start with 10 billion, and over 6 months that ends up at 60 billion and 30 billion for mortgages. Allow treasuries to run off to that max amount. The reason they need caps is treasuries have very chunky maturity dates. 4 times a year, there are massive maturities, and then other months there aren't as much. So to try and smooth it out somewhat, they'll do it. But I think one important question is, how does this affect the market? Well, the US Treasury will need to issue more to pay the Fed, essentially. So it actually matters what Treasury does. Now, the last time the Treasury issued across the curve, and we're expecting something very similar. So there'll be some bills, there'll be some coupons. We don't think there'll be a disproportionate picking of one sector versus another. But that's very important. Every Treasury refunding, I'll be watching for how do they talk about how are they going to fund not just the deficit plus Fed runoff. Mortgages, we don't need to worry about this because the mortgage issue is they buy in the market in terms of whatever is being issued. But for treasuries, it does matter where that issuance happens. And this is where I don't think the market's pricing in the extent of balance sheet runoff, because the portfolio, as you talked about, is so much larger and it is shorter WAM. There's about 800 billion a year that runs out. So if the Fed tries to be aggressive here because they want to move rates higher, or they're under inflation pressure, you could have as much as 700-800 billion more treasuries being issued, which means where are those investors? Well, the Fed's not buying, they're done. So we need to find investors. Do they come from Winnie's asset class or from the mortgage asset class? I think we'll need higher rates, which is why I think that long end still has some repricing to do, because at duration risk, and I was sort of smiling as a duration person, I should be all about buying duration, but I don't think you're getting paid up for all that additional supply that's going to come in. So I don't think it's a non-event. I do think in the very front end, remember there was that repo spike in 2019. That I think the Fed has a solution for. They have the standing repo facility. That's going to be a backstop. It's also going to provide information value to the Fed that reserves are getting scarce. But that's a problem 2-3 years down the road. Before that, I think we have to deal with all that treasury supply.
Sure. So before I turn over to Winnie, I have one more question for you. So if I ask you to, you said you're expecting 4 rate hikes this year, right? So if I ask you to give us a probability of 4 rate hikes versus 1 or 2, but accelerate the balance sheet rundown, how would you balance it?
I think the Fed is sounding fairly comfortable with balance sheet runoff. I'm a little nervous. It's like one data point. They've only done this once, but they do seem to suggest that it's easier. Now, I don't think that happens before. They're going to hike a couple of times. We think 2 times and then start doing the balance sheet runoff. But I would say balance sheet runoff, an accelerated balance sheet runoff is more likely than 4 hikes, because then they can actually start to normalize the yield curve a little bit. I think the Fed knows that it's that 10-year that matters much more for financial conditions. I would even take it a step further. It's 10-year real rates that matter for financial conditions as well as the economy. How do you move that higher? Hiking one more time won't do that. Balance sheet runoff is going to do that faster. So I think I would put higher probability on balance sheet.
All right. So it looks like we're going to have some fun, Winnie. What do you think? How would you navigate this?
So I think that Priya brings up some really great points, particularly when it comes to where do these buyers come from if we see some sort of accelerated balance sheet runoff. Because one of the big theses for corporate credit investors for the past 24 months at this point is that crowding out that the Fed has done in pushing investors into corporate credit, into leveraged loans, into the kind of the riskier asset classes. And investment grade investors looking at all-in yields right now and expecting, well, maybe actually we're going to start to see long end treasuries move a bit higher, maybe more supply is going to be coming online. That's a pretty significant risk to the market, particularly if we're in still this inflationary environment where you have investors looking for more of a barbell strategy where they're going into treasuries and say equities and being able to kind of hedge their portfolios in that type of manner. So for investment grade investors in the US, the kind of one positive is everyone is starved for long end yield. If we actually see this move higher in long end yields, there will be some volatility in the market, but long end IG spreads curves are actually quite steep right now. So theoretically, you do have this benefit of spread curve flattening while yield curves are steepening a bit. And that's a pretty decent operating environment for a lot of investment grade portfolios. Now, we are starting at very low all-in yields, very tight all-in spreads. And so I do think that you can't underestimate the potential for vol, especially in the first half of this year, which was something that we were calling for. But I think as we get a better idea around the Fed's playbook when it comes to both balance sheet and rate hikes, that at the end of the year, you could actually see spreads kind of make a round trip and come back to levels where they are now or even a little bit tighter. Because investors are going to be able to re-rack their yield expectations a bit more.
I was smiling because you spoke like a true insurance investor person, the all-in yields and the book yields. That's what I live by. All right, so let's talk a little bit about the yield curve. I struggle a little bit on this one. So as the Fed tries to land us into a better place, but not really upset the markets, Priya, is there a risk we may have a yield curve inversion? And would it matter?
I think there is information value in that yield curve inversion. And I think what happens forget inversion, if we get really flat, it's not tightening financial conditions. Because if long end rates stay where they are, well, then risk assets continue to do well. The economy continues to strengthen. So how does the Fed then tighten financial conditions? I think they'll never say that they're targeting a level of yield curve, of the yield curve. But inversion or even very flat is, there's credit creation, there's all that issue as well. is the yield curve giving them a signal that, you know, growth expectations are lower? I mean, there is demand. I should say that the global savings glut, we talked about this in 2006, I remember, when the Fed was hiking and long end rates were not able to sell off. We have the same, I think there is just a lot more savings. You know, one of the reasons why Winnie is positive on credit is there's all this cash waiting to be invested. It can prevent the curve from steepening as much despite our high deficit. But for it to, for the Fed to raise rates and the long end just doesn't move at all, is either telling you a really pessimistic view on the economy or that there's a distortion. And right now, the Fed's view is that there is distortion from their holdings of treasuries, which is why I think that balance sheet runoff, if they find that the curve refuses to steepen, I think they accelerate balance sheet reduction to try and see, does that duration take out from the market start to then impact and steepen out the curve? But I will say for now, it's about that terminal rate as well. So I'm not in the steepener just yet because the market's not pricing in 2% terminal rate, which is where we think the hiking cycle will end. So there could be a little bit more flattening pressure, like at least that 2-3 year point has a little bit more hikes to price in. Once we've priced in 2%, then I think the hiking cycle is perfectly priced. I mean, can they go 1 or 2 more? Sure, they can go 1 or 2 less. You look at a lot more symmetric hiking cycle pricing, then it's all going to be about balance sheet runoff, the long end repricing. So I do have a longer term steepening bias once we've got a little, maybe 1 more hike priced into next year. So yes, I think they do want to steepen, and actually a flat curve is going to force them to do, it's going to force the Fed to do something differently. And I think it gives a weird signal for risk assets. If you have this inversion tends to lead recessions. And I don't think the risk complex is pricing that in at all.
Right. I mean, it's actually interesting in terms of the excess cash. Like, I mean, if you look at sort of the overnight repo and et cetera, it's somewhere around a little over $1 trillion. So it's interesting, you know, when you quote the Fed balance sheet and the yearly somewhere around 700 and 800, billion, we can actually sort of drain that number, as you point out, in a very quick way. And I'm curious, again, I'm going to turn over to Winnie to talk about the credit curves and how you see in this environment the credit curves. But it's quite interesting, at least speaking from my end, when I think of the credit markets, I'm not sure that's exactly really thought through the market. I feel like we're so not now near-term focused, a little bit myopic in terms of will they raise or not in March. But just sort of the broader liquidity drain and that normalization. And as you point out, as the treasuries reprice to fair value, whatever that may be, there's going to be cascading impact to the rest of the assets. And I'm not sure that's really have been exactly thought through. Credit curves, I'm fascinated by it. I've been arguing that they should be steepening needlessly. They've just been flat as a pancake, generally speaking. So what is it going to take for us to steepen here, especially on the long end? Again, I'm putting my insurance hat on because it matters a lot given the duration we're on.
I mean, I think that this is the multi-trillion-dollar question, and Powell was talking a bit about it in the most recent press conference about the long end being so stubbornly stuck in the mud. And we can't forget that there is a whole rest of the world of investors who are equally frustrated with the dearth of long duration yield. And so the US still looks pretty good, all things considered, when you kind of adjust for fundamentals and economic outlook. Sure, we could all be buying EM, and we'll hear more about that in the next panel, but clearly there have been some pretty material headwinds to a lot of segments of the EM market. And so I think that there's been this kind of comfort in just kind of sticking close to home in the US markets, kind of grabbing whatever yield you can and just making the best of not the best hand. So I think that in order for, credit yield curves to go steeper, it's going to be so totally dependent on treasury curves, because we've seen a lot of kind of reticence to really reach out and extend duration with this anticipation of a Fed rate hiking cycle and just broader tightening cycle, especially given how big the balance sheet has gotten to. Now, what you have seen is IG has held in pretty well on this most recent rates move. And I think that a lot of that has to do with kind of modest extension out the curve. We've seen kind of the belly hold in pretty well, despite the fact that we've seen an absolute surge of new issue to kick off the year as well. So we're still looking for that, steeper treasury curve to be the thing that kind of kicks the IG yield curve, at least, into a steeper mode, because everything has been just flat, flat, flat. And we have been also recommending that investors kind of stick with that, call it 5 to 10 year segment if you're a mix of all-in yield and spread investor.
I mean, the break-evens are terrible, right? So if you just took the spread and the amount of duration that you're running, it doesn't take much to get just punched in the face. Let's just be honest.
Yeah.
So I want to change it around a little bit. So Winnie, I want to stay with you. And this is a topic we debate all the time. Where are we in your mind in the credit cycle? Is this going to be something new? Are we in an accelerated credit cycle? And then, I can't really see the attendee list, but if there are a younger generation who's never actually gone through the cycle, granted, all of our cycles lately are all bull market cycles, but how would you advise, what are the factors you're looking at to suggest to you that we're moving from one part of the quadrant to the other?
Mm-hmm. So this is a question that comes up in a lot of my client calls, and I have been pretty highly convicted that this most recent credit cycle was very unusual from a dispersion and magnitude to different sectors and issuers. There are some companies that have performed tremendously well, have benefited significantly from this credit cycle, whereas there were proper defaults for some of the high yield companies that had been circling the drain for a period of time and just kind of needed that liquidity catalyst to finally actually call it and enforce them into some sort of restructuring. And so what we're trying to do at CreditSights is identify that spectrum of, where does the sector fall on the credit cycle? What are management teams in the sector doing to their balance sheets to get a better handle on kind of aggregate credit cycle overall? And so we actually kind of put corporate credit kind of squarely mid-cycle, but the dispersion is pretty wide, with some of the most heavily impacted sectors, things like leisure, things like energy, being very much in the early innings of the credit cycle, where we're much more focused on balance sheet repair and deleveraging and being good stewards of debt capital. Whereas you have some companies in the high yield telecom space where all they can talk about is LBOs and really leveraging up and kind of the next transformative M&A initiative. And I think that we've already seen a pretty extended run of compression when it comes to valuations. And now it's going to be all about that single name or idiosyncratic dispersion that is a direct result of kind of the next stage of the credit cycle. But that dispersion is going to be, I think, much wider than a lot of people are anticipating because of how unique this most recent credit cycle was.
It's so interesting to see, for those of us who went from the 14-15 energy crisis, to think of the energy companies, especially in high yield and in good capital stewardship, I know, right? Along with the same sentence. But certainly times definitely change. So let's change a little bit into one of the topics that was mentioned earlier, this wonderful SOFR and LIBOR transition. The leveraged loan market sort of put the blinders on for a little while, just thinking that maybe it may not happen, but we're here. There've been a few glitches in the SOFR market. So Priya, from where you sit, do you see any hiccups? If you're not really familiar with what's happening and you really haven't followed it, you're, let's just say, 2 steps removed, what should you be watching for, if anything?
I think generally the cash and derivative markets have taken to the transition. Certain markets, you talked about leveraged loan. I think the mortgage market, I felt we weren't really making any progress. And then suddenly in the 4th quarter last year, there was that progress. We are definitely in the no new LIBOR world. So, but a couple of things still I'm a little concerned about. How does LIBOR liquidity, I know it's the index that should not be named, but there's a lot of LIBOR contracts that exist. Most of them in derivative space have the ISDA protocol. Cash bonds, have a fallback. So that's good. But how, if you want to unwind a LIBOR position end of this year, early next year, how much will the market charge you for? It's an open question, but it's something I think we all have to grapple with if you have a legacy book. So it's good that you have a fallback, but if you have to trade it, you may want to think about liquidity and actually tracking LIBOR liquidity. We've already seen LIBOR volumes drop off a lot, which the ARC and the regulators will be thrilled about, but I think it's important to note that if you may have to trade it. I'm still hoping for more SOFR futures liquidity, more of the liquidity from Eurodollars to flow through into SOFR futures. It's less of a bank product, so I think it's been slower in terms of pickup, but that should happen. And then something that Barbara actually brought up, credit sensitive indices. I am a little concerned if the market entirely moves to SOFR, is that credit sensitive index is that priced appropriately? Because as a bank, if I'm making a loan based on a risk-free index, am I charging appropriately for that risk? And if I'm not, is there systemic risk? I think this is something regulators need to think about, banks need to think about. Whoever needed that credit sensitivity in their index have to think about top of the house hedging or something else, otherwise, or making sure that you've appropriately priced it, because that is a big shift. We're going from a credit sensitive index, LIBOR, however problematic it was, but it had a credit component, to now a risk-free index. And maybe that still needs to be worked out, that price of credit.
Sure. I mean, you can create notable asset liability mismatches on the banking side, because obviously Fed most likely is going to control the SOFR based on its actions, and you can really create a lot of distortions. So I don't want to go too technical with Winnie on this one, but while we're on the topic of leveraged loans, let's talk about the loan market, right? So loans and high yield, I believe, is a consensus long this year across the street based on what I've read. IG, unfortunately, has not a whole lot of love so far. So when I'm sure you talk to your competitors, and you probably think about this as well. Is consensus being so pigeonholed into the same recommendations? And if you even spread out the spread targets across the banks, right? Everybody is fairly within a spitting distance of each other this year. Is that a concern? If you're in our seats investing, would you be concerned?
It's always a concern when everyone's on the same side of the boat, for sure. So I would say that one of the things that I have some caution around is the consensus long or constructive view on leveraged loans is a combination of a few different factors. There's first the expectation that we have this persistent inflationary environment that leads to rate hiking, and we need to have inflation hedged asset classes, including leveraged loans, in our portfolios. So if we actually see, the Fed kind of failure to launch on this extensive rate hiking cycle, you never get that upward kick in from floating rate components of loans, given how many floors there are as well. So the upside there feels a little bit less optimistic for me, as maybe some investors are thinking. And then you have to drill down to credit fundamentals. And we've seen the leverage loan market become the preferred vehicle of private equity, and a lot more kind of leveraging transactions, all that leverage lending guidelines we're going to limit leverage points on new issue in the loan market haven't been enforced for a fairly extended period of time. So you've seen some fairly aggressive deals come down the pike. And also you see much more loan-only capital structures. So you don't have that subordinated unsecured debt cushion that really kind of helps when it comes to recoveries. And then finally, another thing that investors have been looking at is how well the loan market performed in March and April of 2020 amid all the volatility. The volatility in loan prices was not nearly as severe as some of the kind of higher quality, more liquid asset prices. And some investors have kind of pointed to that as, evidence that the loan market is fundamentally sound. It's not going to be kind of a systemic risk that a lot of times the financial press likes to make it, along with its, CLO sister market. But I think that assuming every credit cycle, every economic crisis is going to be the same as March and April of 2020, and monetary response and fiscal response is going to be similar, is an assumption that I'm not willing to make, mostly because I don't really want to go through that again, especially if we have to do it for years on end. So
you don't want to work from home forever, like
that part's it's not so bad. I am wearing my fuzzy slippers while I'm presenting, and I'm okay with that. But, I do think that you need to make some assumptions around, what does a more normal economic cycle look like? What are the underlying assets in the leveraged loan market at this point? How sensitive are they to cash flows? Is there an overweight allocation to specific sectors where you might have more concerns? And then also layering on, the reality of the LBO and M&A transactions that have occurred in that market. I get a little bit more cautious on the kind of long-term potential for the loan market to kind of outperform US high yield, because high yield has not seen to the same extent that type of kind of releveraging fundamental deterioration.
Noted. I think the other piece on the leveraged loan market, perhaps I find that the market a little underestimates. They just look at the outright spread, but because the leveraged loan is always pre-callable at par, and over the last 2 years, investors really got caught on the wrong side of that, because every time they got called at par for the repricing cycle, I think there's also a reversion of the market to sort of increase the value of that. So I think there's a little bit of an artificial highness of that spread because of the technicality in the instrument. But I tell you, whoever came up with the sort of the mantra that rising rates, you buy leveraged loans, that person, requires an award, because I watched the inflows into the mutual funds, and it's like autopilot. It's quite fascinating. So one last question on the leverage loans, right? I think one of the things that's been well flagged is sort of as you pointed out, the growth of this notable single B component, right, versus high yield. If you look at the spreads today, yes, the loan market is a little wider than the high yield market, but in grand scheme of things, it's nowhere distressed. There's actually very little distress component in the loan market. So is the credit deterioration in the leveraged loan market, is this something we're going to go pay down the road?
Probably. I would love to say that we're going to have just these kind of bull market cycles, and it's going to be, nickels and dimes defaults, and not as wide magnitude as we've seen in other credit cycles. But I do think when you have an asset class that has been, a very direct beneficiary of a lot of dollars coming into specific markets on perception of inflation and kind of economic growth expectations, then you do need to become a little bit concerned around asset bubbles and what you're owning and the problems associated there. So I don't think that the leveraged loan market is going to take down the financial system, but I do think that assumptions around recoveries and defaults need to be weighed with the reality of what capital structures look like now, and what these leveraged loans have been used to fund when it comes to LBOs and other transactions like that. So we had long been calling for this kind of convergence in recoveries between first liens and senior unsecured, just because of how capital structures have evolved in both the high yield and the leveraged loan market. And I think taking it even a step further is looking at the high yield market and how its quality has evolved since the great financial crisis. There's a tremendous argument to be made for much tighter spreads in the high yield market than what we have now. I think the all-in low level of yields has been a little bit of a roadblock to spreads going much tighter from kind of the 300 basis point area. But if you look at the construction of ratings composition now versus, call it 2005 and 2006, when high yield hit its prior all-time tights, then we should be trading a lot tighter overall, especially if economic fundamentals are going to maintain some momentum for at least a couple of years.
Noted. Excellent. So let's move. I think we have just about 10 minutes. So I think it's a good time to do a little bit of a lightning round. So Priya, I'm going to come back to you. Your strongest conviction for 2022?
So apart from being humble and nimble, trades, I would say it's being short, long, and real rates. When people say don't fight the Fed, don't fight the Fed on long and real rates. Because, the last time they started raising rates, 2015, 10-year real rates were 50 basis points. When right before COVID started, we were around 0. We're at -80 or -75. Actually, we did move a little bit today, but we're minus 75 basis points in terms of long end real rates. The only way the Fed can tighten conditions is to move this higher. So I would say don't fight the Fed and go short long end real rates. If you're nervous about high inflation, have some front end inflation protection. So 2-year break evens, you can own some tips in that very front end. But the long end, because if inflation's high, it can prevent real rates from repricing. But balance sheet runoff, just the deficit and all the treasuries that we have to take down should mean higher long end real rates.
I love it. Don't fight the Fed. We always use it for a bullish argument, but I think you're the only one who I've just heard to use it on the other side. Excellent. Consistency. How about you, Winnie?
So you kind of alluded to this earlier, and it pains me, but one of our top picks is still energy in both high yield and investment grade. And as someone who started their career in strategy in 2014, the sector has been nothing but a thorn in my side for the past 7 years. But I think that like home building in the post-Great Financial Crisis era, there is the argument to be made that some sectors kind of finally learn their lesson and become better stewards of capital and are opportunities to perform pretty nicely.
All right. Yeah, I have quite terrible memories from that era as well. Actually, I'm against consensus, so I am long USIG.
Ooh.
So yeah. All right. My other favorite question. What would you see? Let's start with Winnie this time. Go backwards. What's in your mind? What is the pain trade this year?
Long USIG.
Awesome. Excellent.
I mean,
I'll have to see if we have a CreditSights subscription.
There are an awful lot of investors who are long USIG, and I empathize with the sentiment that we can't fight the Fed and we need to kind of follow the Fed. But I would say that the pain trade is probably if rates actually go lower and we see somehow USIG really outperform on that total return basis because we have falling yields. Probably painful because that implies some sort of economic crisis that the Fed is going to have to really, turn tail again and reverse its messaging.
Look, if you're an insurance company, you live with the long duration.
So true.
Priya.
So I would say there's, at the risk of being an economist here with one hand and the other, but I think the pain trade could be both ways. Like if growth slows down, everyone I'm talking to is talking about growth stays strong. There's like an assumption that the Fed will hike and growth stays strong. I don't think Fed hikes slow growth because that takes a while and the Fed has to hike a lot. But what if there's fiscal drag as well? What if growth was so strong because we got checks in the mail, or a lot of people got checks in the mail and that was spent out and that's done. And if growth starts to slow down, but the Fed is under the gun of inflation and therefore they have to keep hiking, how does the market sort of start to price that in? And I think being long something in the front end, it's out of consensus. People have told me I'm crazy because the Fed's hiking. How can you go long the front end? Well, when you price in 4 hikes in a year, I don't think they're going 5, but they could go 3. So maybe that's one pain trade. The other one is if inflation accelerates. I mean, we're looking for it to actually decelerate, but does it make it really hard for the Fed? Do they have to pull a Volcker? Maybe not as much as Volcker, but do they need to hike more than neutral, really tighten conditions because they are forced into it with high inflation? I think owning some tips break evens for that. And linked to that would be, do we get fixed income? This is the point where the Fiazi might like kick me out of the Zoom, but do we get fixed income outflows, right? We haven't seen an outflow year in a very long time, and that's not our base case at all. But it is something I'm nervous if total returns start to get negative because that credit component was just not wide enough to take care of the duration move. Do you start to see outflows? And then in a fixed income vulnerable environment, liquidity wise, does that feed on itself? So there's like tail risk everywhere, but I'm a government bond strategist. So I'm paid to think about, or not paid, but certainly I'm supposed to think about everything that can go wrong, but I can see risks on sort of both sides.
Sure. And I think this is one year with a tail risk. You just sort of look into the options market to hedge as much as you can. Yeah, I think the pain trade to me is rates lower and equities lower. Because clearly that's not really being priced in. So we have about 2 minutes. It's the last question. What can you see to be a surprise event for 2022? I'll start with Winnie. So my guess is I think inflation, instead of this projection in the second half that it's going to trail off to 2, we may actually end the year somewhere around 4 or maybe slightly higher than 4.
I agree with you there. I think another thing that investors need to consider is political risk and, what do the midterm elections mean for policy and spending? As Priya just mentioned, we do have this kind of headwind coming from the roll-off of fiscal stimulus and people not receiving checks in the mail. It seems like consensus expectations right now are that we see the Republicans retake the House. Senate feels like a little bit more of a toss-up right now, but we still have a long way between now and the midterm elections. So what if we actually have a Democratic surprise and they gain some seats and all of a sudden Build Back Better is back on the table? What does that mean for kind of the outlook for growth, for government spending, for taxes? All of these things I think are being a bit discounted by the market right now. And we'll all be hearing a lot about politics for the next 11 months because we know that the season starts earlier and earlier. So everybody get ready for that.
Sure. Priya?
I would say spending, consumer spending. This is the year, well, we said that about last year too, where we were supposed to move from good spending into service spending. And at some point, does good spending start to wane off? Because we've bought our 2 monitors and our fuzzy slippers. And now you're supposed to move into service spending, and that's still slow. And, I think that will concern the Fed. So it sort of goes back to maybe we're not pricing in this risk that, growth stays this strong. But does that handoff, is that handoff a little less smooth than I think what everyone's sort of penciling in?
Well, in a true fixed income version, we all thought about the surprises being all negative. So congratulations, we all have our fixed income badges. Priya, Winnie, thank you so much for the lovely discussion. And I'm going to turn it over to Joyce Chang, who obviously needs no introduction. But Joyce, the floor is yours.
Thank you so much, Lale, and great to be with all of you today. I mean, who would have thought there were even 1,000 women in fixed income? What I'm most excited about is that hopefully next year we will be able to meet live and in person and to see all of you at this event, which is really one of my favorite events of the year. So it's just wonderful to see so many friends and colleagues and people I have known since the start of my career. A real thank you to Barbara, who I have so long admired and respected and followed since I began my career. So, and to all of the sponsors, to S&P, to CreditSights, and to Fitch for hosting this event. So just a little bit about myself. I hate to sort of admit it, but this is my 32nd year as a researcher. And I started as an emerging markets researcher at Salomon Brothers back in the old days, focused on fixed income, was for the first decade at Salomon Brothers and Merrill Lynch, and have been at JP Morgan since 1999. Evolution of sort of looking at emerging markets, then broader fixed incomes, managing the research team, and now as chair, focusing on more strategic and thematic research issues, including ESG, geopolitical risks, the shifts we're seeing in market structure. I'm delighted to host the international panel and to just say a brief word about Janet and Cathy and let them just talk a little bit more about their background. But the diversity agenda has also been something that I've been very passionate on as one of the senior sponsors for our Women on the Move network for the investment bank, and also as a sponsor for our Asian employee network across the JP Morgan Chase platform. It's just truly a pleasure to introduce Janet and Cathy very briefly. Janet has had a long career, starting in Asia with the Asia financial crisis, and at HSBC, and then Europe, and now as a global chief economist, and serves on a number of the different shadow committees for the ECB. Cathy, I have known practically my whole career. She's co-founder at PGIM Investments of the emerging markets fixed income effort there, and has somebody that I have just long worked with for so many decades. So let me, Janet and Cathy, just let you just add a little bit more about your background before we get into the discussion.
Okay, thank you, Joyce. And well, you gave a brief summary. Yeah, I've been with HSBC for about 25 years and was really the crisis economist. I'm usually the lead. I was the Asian economist just before the Asian crisis. I was made the European economist in 2007, just before the global financial crisis and the Eurozone crisis, and then global chief economist, well, just in time for a global pandemic, but at least I had a couple of years before that actually began. And it's a great pleasure to be at this event and to hear what an amazing, that I really enjoyed the previous panel, exceptionally good and eloquent people speaking on that panel. I know that women are still underrepresented in fixed income, but it just keeps getting better. And I would say when I joined HSBC 25 years ago in a team of 50 people in economics, I was the only woman. Today, I have a team globally that's 40% women in economics in a bank. So we're making big inroads.
Well, that is really something to be congratulated on. Cathy, just a little bit about your background.
Sure. So I've been with PGIM Fixed Income for about 32 years. And as Joyce mentioned, I started the fixed income effort here back in 1996. So been really managing a team of a wonderful team of economists and portfolio managers and analysts as the asset class has grown. So as Joyce said, I kind of feel like we grew up together here, helping the asset class evolve along the way. And fortunate to be able to manage lots of different strategies in EM, including sovereigns, quasi-sovereigns, local, ESG, long, short, et cetera. So, you know, very much enjoy the ability to experience all that EM has to offer, all that EMD has to offer, and all of the vicissitudes therein. I lived in emerging markets. I lived in Latin America as an undergrad, and I've always been passionate about emerging markets. I don't know why. I like to think that perhaps in a former life, you know, if I do admit to subscribing to a view of reincarnation, like I lived in Elizabeth Allende's Chile or something like that, because I've always been fascinated with Latin America, and now, of course, invest globally across the end.
Thank you so much, Cathy, and thank you, Janet. So, you know, last year, and we heard from the excellent panel of Lale, Winnie, and Priya, you know, it was a year of U.S. exceptionalism. The U.S. has been leading on everything, you know, higher inflation, you know, a lot of the growth numbers, the asset returns for asset classes. And this year, the question that I am getting, is this the year really to rotate into more international? And I thought I would start, Janet, just with you, big picture on, you know, what is the nature of the global recovery that lies ahead this year? And where are we? We talked about the credit cycle. Where are we in the growth cycle right now? And Priya had mentioned that you know, Omicron puts more inflationary pressure, more pressure on the Fed. Do you think we're close to peaking with inflation now?
Well, I suppose that the question in terms of where we are in the economic cycle, are we at the beginning, the middle, or near the end, really will hinge on whether the Fed can engineer a soft landing in 2023 or indeed 2024 as a consequence of the tightening that it delivers. So maybe we'll move on to the policy element of it in a little bit. But in terms of how we see the growth outlook in 2022, I think it's still going to be a bit uneven and still likely somewhat volatile, as indeed it was in 2021. In the previous panel, they talked about, you know, the possibility of the fiscal support fading. That was already fading in some of the emerging economies. And a lot of the easy bit of the recovery, the pent-up demand, has already run its course. And already what we're seeing as we enter 2022 is something of a cost of living squeeze. But we know that as much as we talk about US exceptionalism, and there has been US exceptionalism, there's been really exceptionalism amongst the advanced economies. The recovery in the advanced economies has been much, much swifter than in the emerging world, helped, of course, by this extraordinary policy stimulus, much of which has actually been saved. And that's the bit that we all know is impossible to forecast. How much is savings rates? Well, in the US, it's already back at pre-pandemic levels, but the stock is still huge. It's equivalent to about 18% of US consumer spending. And depending on how much of that is spent, it could, of course, offset a lot of that, cost of living squeeze, depending on the distribution of income. But also, I think there will be a rotation in the growth mix globally. We had much of the world in EM and the advanced economies having a consumer-led recovery. In Asia, we had much more of an export-led recovery, which, the machinery of the world, the factory of the world, generating the exports to meet that consumer demand. And there's every reason to think that world trade growth is going to be a lot slower in 2022, and that actually consumer spending is going to be a bit slower, and we'll see this rotation from goods to services to a larger degree. And there'll be certain areas of investment spending, particularly with Europe's next generation EU fund, should be starting to support investment to some degree. And in terms of Omicron and how it changes things, yes, I think it will have an impact, and arguably it might be a bit different to in the past. Obviously, at the moment, the data from South Africa has been quite encouraging in terms of the idea that you get a surge in cases, but it peaks quite quickly, and then cases come down, and this is all part of the transition towards it becoming somewhat more endemic. So really, it comes down to how governments respond, and indeed how households and companies respond, and what that means for demand and what it means for bottlenecks. Now, a lot of the last year, the bottlenecks were much more acute in the US and in Europe, much less so, fewer disruptions to the supply side across Asia. But Asia, particularly China, has got many more restrictions, even just on a fewer cases. So arguably some of the supply disruptions could come more from Asia than elsewhere, and you could see some weaker growth. So in terms of what we've done as a consequence of Omicron, we've lowered some of our forecasts for the start of the year for Europe, and indeed for China. But in Europe's case, we've got some of that pent-up demand coming through a little bit later. And in China, we've got more policy stimulus.
So no, thank you so much, Janet, and a huge thank you to Janet also for joining us on London time. So it's evening her time, and for being with us. Cathy, let me turn to you to just talk about the emerging markets, because it had already been a tough couple of years for emerging markets coming into this pandemic. And when we talk about uneven recovery, it is really dispersed across the emerging markets. So what is the new normal for emerging markets post-pandemic? What are the consequences for this? How have you seen the perceptions regarding emerging markets change from investors over the near term, how they think about it from the perspective of long-term investment? And how are you looking at prospects for capital flows, returns, and risk?
Sure. It's really all about differentiation. And if I start with how the end investor is looking at the asset class, and again, this is spanning credit, local, FX, et cetera, I think that they realize that there's huge dispersion of performance and returns among the different sovereigns, because as everybody knows, within EM sovereigns, our investment universe includes AA countries, and it includes countries in default. And the dispersion of returns is incredibly wide. So there are more and more investors who are seeking to get a higher quality flavor, if you will, of investing in emerging market debt. So maybe they're customizing benchmarks. Maybe they're saying, I don't want to invest in CCCs or sovereigns in default, or I only want BB countries. More and more investors, I think, are looking at how resilient emerging market corporates have been, not just in last year, but in 2020 as well, and wanting to get more exposure either, implicitly, if you will, or explicitly to the emerging market corporate sector. More and more focus on ESG. Obviously this was something that was happening well before the pandemic, but for whatever reason, I think it has accelerated the focus and the willingness of the end investor to want to, again, further differentiate in how they were choosing to get exposure in emerging market debt. So I think that the end investor is saying, I know that there will be lots of volatility in this asset class. And in fact, as we look at the flows over the past few years, there have been, away from local China bond funds, there have been lots of outflows in other local bond markets. And we could talk more about why later. So I think that there's less and less interest in some of the EM local markets. Maybe that has everything to do with volatility in the EMFX, and it's really hard for EM local bonds to do well when emerging market currencies aren't doing all that well. And this gets back to, okay, so what's changed from the perspective of the country's economic fundamentals? And it's really growth. You can boil it down to growth. Yes, some emerging market countries are more levered, and it's much more challenging. But at the end of the day, growth is just going to be a lot slower for many of the emerging market countries. And they have to deal with the consequence of that. And in the political realm, one of the consequences of that is increased populism. Populism has always been around in emerging markets, but it's with a vengeance, it seems. When I look at elections that have happened so far in Latin America and that are likely to occur this year, and what that then means for policy and how investors are going to look at how able and willing the different countries are to deal with a slower growth environment. The slower growth in part is a function of the slower growth in China, which would have happened anyway, regardless of the pandemic. It was inevitable, but it will have its repercussions, I think, for the rest of EM. It doesn't mean that it's not an investable asset class by any stretch of the imagination, because I think what's happening DM is very supportive for EM. From the perspective of flows, it's really interesting because there were still positive flows. We look at retail and strategic flows across EM. As I mentioned, not very many went into EM local markets except for local China, but there were positive flows across hard currency. There were really positive flows into EM equities. So that tells us something, perhaps. But when we look at the supply and the appetite for some of the, we look at new issue supply and I look at the appetite for some of this supply. 2020 and 2021 were pretty strong years for sovereigns and in particular for corporates. So one can't really say, well, emerging markets don't have market access, because they do. If you look at new issue supply, that's clearly the case. And while over in 2021, spreads didn't really do very much, the spreads didn't tighten. Spreads returns did okay on the index, and spreads did okay in corporates. So investors, basically said the expectation for returns or for spreads is perhaps limited post-pandemic, and they reflected that with positioning. So positioning really across all of the different EM segments is pretty light. And I think one of the reasons why 2022 could be an okay year for emerging market debt.
No, thank you so much, Cathy. And it is true that for emerging markets, it's much harder to categorize it. You've got the frontier markets, you have China in there, and you also have, just as we heard about in the credit markets, this sort of single B segment as well. But the market access has been there. So, Janet, I'd really like to turn to the Fed, what central banks are doing, and what you expect from the Fed. So Priya says she thinks it's going to be March, but maybe not for hikes as people are talking about. How are you seeing where the Fed is right now? We've had unemployment, output gaps, falling much faster than what we have seen in previous crises, but inflation running much hotter, and then this whole shift to quantitative tightening and a debate on what is the neutral level for the balance sheet, how the Fed's analytics changed around this. So, what do you think the Fed will do? Are they trying to move preemptively when the economy is doing well, or are they actually really falling behind the curve at this stage?
Thank you, and I'm conscious that you did ask me about inflation in the first question, and I didn't actually address it. I think for the Fed, the balance of risks has changed. We all know that the Fed has got a dual mandate, but it's very clear that inflation is now the dominant concern. And from here, it really is, I think, about the Fed's credibility. It's not arguably behind the curve, but it is in danger of falling so. And it's very, very clear for a number of reasons that the economy no longer needs QE. That's why they obviously started the taper and made it clear it'd be quite quick. And already they're talking about shrinking the balance sheet. And I think, yeah, we think that they'll start raising rates in March. And in fact, the change for us came with the December FOMC. And I'm aware that the minutes were more hawkish. And since then, the testimony of Powell has, we always thought that the balance sheet runoff would start in the final quarter of 2022. If anything, the risks are that it starts even earlier than that. I think it's very difficult to say that there is a neutral level for the balance sheet. There is no magic level. It just depends on what happens to financial conditions, both within the United States and globally, as to when they will have got as far as they want to, or indeed as far as they need to. And I've always believed that the Fed does pay attention to global developments, because global developments impact on what's happening in the US economy itself, both on the inflation side and what's the appropriate course of policy. And I think we've had numerous instances of that over the course of the last couple of decades. So I think the Fed, we get back to this, as Priya was saying, the Fed has made it clear they want to be humble, they need to be humble, and they potentially need to be nimble. The dominant concern right now is inflation, but as Powell has made clear, the type of inflation the US economy is facing is not the type of inflation they expected to see when they came up with their framework for flexible average inflation targeting. It's been much, much more supply driven. And in the near term, the risk is that the supply situation gets worse because of Omicron, but some of those other supply constraints as the year progresses, whether it's in components like semiconductors, whether it's in finished goods, whether it's in services from shipping to restaurants, or indeed the speed with which workers come back into the labor force because their caregiving responsibilities or indeed their financial cushion has lessened, or indeed they're less fearful about COVID. All of that is going to impact on the supply side of the economy, and therefore onto the speed with which inflation actually starts to fall down. So I think that the difficulty for the Fed is, and it's not just Powell, it's been Neil Kashkari that's been quite clear about this as well. At the moment, the priority is to lean against a further rise in inflation and the risk that it becomes more persistent and that inflation expectations pick up, but they also need to be ready to recognize that actually some of those global disinflationary forces that were evident pre-pandemic may reassert themselves at some point, and we may be going back to lower inflation, and therefore that they might, needlessly slow the economy down too much. So, often we start the year with incredibly hawkish approach, with people even thinking the ECB could raise rates, and then things lessen to some degree. But our view is that, yes, the Fed starts in March, they raise rates 3 times in 2022, and they start the balance sheet runoff. But a bit like Priya's view that the long-term neutral rate, the terminal rate, is still below the 2.5% dot that's been presented. But I think we will go through volatile periods depending on all these different factors regarding expectations in the coming year.
Thank you so much, Janet. So March it is. But Cathy, I want to turn to you and ask you how you would paint the picture for what the monetary policy outlook is in emerging markets, because this time it isn't synchronized. We have seen that a lot of the emerging markets central banks outside of Asia really started tightening much earlier, middle of last year, in response to higher inflation. They didn't have the fiscal space. So how do you think emerging markets fares this time as the Fed embarks on rate hikes? You also think this is going to start in March, and frankly, a lot of emerging markets really hadn't even really recovered on local markets from the Fed taper tantrum to begin with. So what is different this time, since EM really is not in sync as much as it has? Is it going to actually perform better in the cycle?
Yeah, I think there's some scope for some countries to actually do better. Because there are some, what I would consider to be fairly orthodox EM central banks who are actually ahead of the curve. And I'd put in that category Brazil, Russia, maybe Czech Republic, who were very aggressive and early in their hiking cycles, and because they had to be. In the case of Russia, they're just super orthodox. But Brazil, because of the fiscal weakness that the country has, as well as some of the political uncertainty and the inflation pressures, they just had to be out there and be ahead of the curve. So there's tremendous amount of rate hikes priced into the curves. So I think that there's scope for those countries to fare okay. What's different from 2013, even though perhaps some of these countries still haven't fully recovered, and those are probably the Turkeys and maybe even the South Africas of the world, more on Turkey later, is that they're in a much better position from a current account perspective. Growth is a lot lower than it had been. And as I said earlier, I think it's likely to remain lower for many emerging market countries. But the current account position, obviously, because of what happened in 2020, is in a much better place. And because many of these EM central banks, and even those that are deemed to be kind of with the curve, maybe the Mexicos of the world, or some of those behind the curve, in particular, some of the other CEE central banks, and maybe even a Colombia, their balance of payment position is a lot more comfortable than it had been. So I think it makes them a lot less vulnerable from a sudden stop perspective, in that one very specific realm. Now, obviously, there are other things happening that could cause individual countries to experience repricing, but the market has priced in a lot of hikes. Just look at the spread on the GBI curve. It's almost at 6%. Significantly higher than, say, the 10-year Treasury or even other G3 rates. If you look at that over time, it's not an unattractive level. Of course, we have to wait to perhaps see if inflation levels do come down, and they will, because they're not going to get the same year-over-year impact that they had in 2021. So I think it will come down. And then it's really all a matter of investors looking at, obviously it's very expensive to pay rates in some of these countries, and some of these levels are very attractive already. And I think how investors are going to differentiate themselves is by relative value. Picking those emerging market countries. A lot of these local curves are very flat, which is interesting, I think, at this point. And so you don't really have to go out the curve. If we think that there's a lot of rate hikes priced in, you could be in the 5-year sector, which we think is really attractive, and just have a group of overweights and underweights. And I should have mentioned this earlier, and I think that's another thing that makes the asset class a little bit different. Is it's not about beta anymore. It's really all about figuring out how you're going to generate alpha. There are tremendous opportunities for alpha in emerging market debt. And it's all about sizing your overweights and your underweights and doing those appropriately. Then, of course, you have the Turkeys of the world who are trying to, rewrite economic textbooks in terms of, what's the right way in which to conduct policy. And what I think is going to happen in those instances is the investor base is just, it's very, very challenging to invest in that market. The investors are just going to not want to invest in those sorts of markets.
So so you really do have to be very selective right now, and then sizing the overweights and the underweights, that's something we're coming back to. But Jenna, I want to come back to you really just to talk more about this persistent divergence that we've seen between developed markets and emerging markets performance, this gap, and also where China is going, just for you sitting at HSBC. So we had this initial V-shaped recovery, and then we had common prosperity, and talk about really trading off the pace of recovery for other goals, longer term goals for financial stability and for basically assuring the stability of the middle class. So how are you looking at how this gap will close or widen, and China specifically?
Yes, you're right. I mean, it was, China had one of the strongest recoveries. In the initial V-shaped recovery, actually, believe it or not, Turkey had a stronger rebound than China for a period, but that's a separate story. But I think China, having had its V-shaped recovery, did as you say, revert back to its kind of pre-pandemic structural goals, which was all about, I suppose, an evolving growth mix that was meant to be less dependent on investment spending, more driven by consumer spending, and common prosperity was a big part of that. There was a kind of a corporate element to it, about strengthening small and medium-sized enterprises, encouraging entrepreneurship, etc., but also a lot about narrowing income and wealth inequality, improving the social safety net, and really about supporting more consumer spending. And what has gone wrong with that, I suppose, is still COVID-19. To some degree. So what you've seen in China in the course of the last few months, obviously, is that we've had another few waves of, well, the latest wave of the pandemic at a time when they'd obviously really wanted to rein in the property sector, and they had moved towards the financial sector deleveraging. They particularly started to put the squeeze on the property sector. And now, with growth having slowed by more than they had intended, and even consumer spending in the short term being at risk too, because of renewed restrictions coming into place, they are having to ease up on that policy approach. We've already seen some easing in lending towards the property sector. It'll be a while before we see that in construction activity, and we're also seeing easier financing for local government spending. So we will see a pickup in infrastructure spending and green investment. So in terms of that China growth trajectory, it's still going to be very weak growth. In the first quarter in particular, maybe through the first half of the year, more monetary easing in the way of reserve requirement cuts and possibly another rate cut. But we are looking for a more meaningful rebound in the second half of the year, where we are still thinking that they probably will hit that 5.5% growth. So their longer term goals, common prosperity, more consumer driven growth, to be more like the United States, is still there. But growth has slowed too much, so there's a bit more emphasis in the near term on these more reflationary type of policies. But in that, broader question of a DM-EM performance gap, I think relative to potential, it continues. It's interesting, we have not materially lowered our estimates for potential growth in the US, or indeed from even the Eurozone. Now, admittedly, in the Eurozone, potential growth is probably only about 1%. But if they do everything that they're saying they're going to do on the Next Generation EU fund in terms of the loans, the grants, and the structural reforms, then that potential growth rate won't have fallen. It might actually increase in the coming decade. So for the emerging markets, actually, they'll be growing more swiftly. But by our forecast, the emerging markets generally, as a consequence of the pandemic, will be on a lower growth trajectory than they were before the pandemic, because of the depth of the recession and the lack of policy support and reform that's come into play.
No, thank you so much, Janet. And we also have taken some of the forecasts down for potential growth for emerging markets, which took a hit at the global financial crisis, but we think it's down probably another 0.4% for potential growth just as a result of the pandemic. But Cathy, I want to turn to you and ask you, what is an investor to do about China? So China is now in the mainstream indexes for fixed income, and allocations from foreign investors are still low single digits. How are you looking at China? And the other side of common prosperity has been this crackdown on, we saw this with the education sector, various sectors, and then the fallout from Evergrande and just the ongoing issues from the property developers. So how do you invest in China for your funds? And how do you see the outlook for China? And where do you see the opportunities and the biggest risk?
Yeah, so carefully is, I think, the short answer. Let me start with the what happened with the property sector. And it was, perhaps it's best characterized as an oops moment for policymakers in China. And I completely agree with Janet that I do think that there's going to be a policy response as a result of that. And China has the ability as well as the willingness to try to accommodate that. I do think what we learned is that it's dicey for external bondholders to own China property bonds. And even those that, I mean, and investors did a decent job of differentiating between those that were more vulnerable and those that were purely investment grade. And initially, the market did differentiate between those. And obviously, the big difference is the amount of leverage that they have and the amount of refinancing that they have. But as more and more negative news came out, and it's still not 100% clear on how all of the different names are going to be remedied, you continue to see downward pressure on prices, even for some of what we would consider to be the better quality property companies. So what I think that means is external investors are going to be at the, look at the shorter end of the stick. That doesn't mean that the recovery values are going to be zero, but it's not in the best interest necessarily of the policymakers to not make sure that the wealth management holders or the domestic stakeholders fare better. So I think that that's likely to be an outcome. So we're not really that enamored of the property sector. But if you look at how the index, the sub-index of the CEMBI of China performed, the investment grade segment actually did okay. So if you picked the right names, or if you're in SOEs that are considered to be strategically important and don't end up on an executive order, the performance is actually okay, but you're not going to really outperform by having a big position in these higher quality Chinese entities. It's an okay exposure to have. Where we really prefer to get our exposure is in the local China bonds, and in particular in the CGBs, the central government bonds. There's not great liquidity in any of the local market bonds. But it's very much a priority, I think, for the Chinese authorities to make sure that that market continues to develop and that it performs well. And then just from a macro policy perspective, we do think that they're going to continue to want to ease monetary policy and the very many different ways that they can do so. And that will help the attractiveness of those bonds. The currency, right now, given that the growth is downshifting, probably a little bit less attractive way to get exposure. But there are other currencies in the region that I think are more attractive.
And government bonds, the Chinese government bonds, is there enough of a risk premium there that is attractive?
Yeah, I tend to think of the Chinese local bond market as a developed market, to be honest. And so if I look at real yields there and compare it to real yields in other developed markets, I think it's attractive enough. It's an incredibly big market, and from just looking at it from a policy perspective, I think it's attractive in that regard. 2 years from now, if we're in a different cycle and some of these other local emerging market bond markets, or even sooner than that, begin to look more attractive, then perhaps there will be a better differentiation between what you're getting in China. But there's always been that distinction in the GBI between those that trade more like DM, your kind of mid-quality, and then your more volatile ones. And China will just kind of go along with all of those other Asian local markets and perhaps, be more of the premier Asian local market.
Well, thank you so much for that, Cathy. So food for thought, think about China more as a developed government bond market and much of Asia that way. So, in the last 10 minutes or so of this, I want to do a rapid round robin as well. And, first of all, we've heard actually quite a few consensus views here. Fed hikes that begin in March, is it 3 or is it 4 hikes, sort of a bias it seems from this group that it's going to be more 3 hikes rather than the 4 hikes. So I really want to start and just kind of say, Janet, what is your most out of consensus view? What do you think could actually be the biggest surprise, and where are you most out of consensus? When I look at all of the year ahead reports that I've seen come out over the industry, there's quite a lot of consensus in the views right now.
It's almost hard to keep track of where consensus is. As you said, on the Fed, consensus has shifted very quickly and all in the same direction. So it probably wouldn't be on the Fed. It might on the most non-consensus views might actually be in some of the emerging economies, and I suspect that maybe Cathy's got a similar one. Brazil is an economy that we have actually highlighted as where the inflation could peak a bit earlier and the terminal rate might be a little less high than the market's been anticipating. The fact is there's been a quick and aggressive tightening cycle. The economy is going to be slowing very sharply, and we actually see inflation in Brazil coming down more swiftly, whereas in some of the other emerging economies, it's quite clear that they are still actually behind the curve, arguably in parts of Central and Eastern Europe and maybe even the likes of India. But finally, on the interest rate side, it wouldn't surprise me at the moment the way suddenly every central bank is expected to tighten and been moving it forward. People are also speculating the ECB could even raise rates in 2022. That's something I disagree with. I know the ECB's got a form of tightening prematurely, but I do not anticipate an ECB rate rise at all in 2022.
And when will the ECB raise rates, Janet? I mean,
yes, good question. I should say pre-pandemic, I never thought that they would find themselves in a position to be able to raise rates. But we recently, at the end of last year, put in a rate rise for the ECB. Basically, we think that they'll halt the asset purchases in the middle of 2023 after a very short taper. And given what they've currently told us about sequencing, the window for the first rate rise would be September 2023. But if the Fed hasn't managed to engineer a soft landing, they may not get that window.
Okay, so nothing in 2022 and even well into 2023. So Cathy, most out of consensus view, and when you think about emerging markets, I mean, where do you see the best value? Is it really that you stay in the higher yielding just to get the yield, or is it that, as you mentioned, investment grade China actually did okay? So where is the best value, and where are you most out of consensus?
Yeah. So the best value, I think, remains in credit and in spreads. And in a barbell of that. So, and what I mean by that is you can invest in investment grade 30-year bonds of countries, like maybe it's an SOE in China, maybe it's a GCC country. The GCC countries have a lot less to issue this year, and from a fundamental perspective, they're actually doing quite well. And they're very, really steep spread curves, in EM in particular. So you have some of those, you have some double B quasi-sovereigns and corporates, the shorter end of the curve. And then you have a mix of single B, maybe sub-Saharan African countries, like in Angola, countries that are going to benefit from the fact that commodity prices, and particularly oil, are likely to remain elevated, and a country that has a decent relationship with the IMF that doesn't have to refinancing. Doesn't have refinancing needs per se. I think that having a mix of those issues at the front end so that you get that extra carry and that really positive spread return makes a lot of sense. So still be overweight corporates. I agree with Janet that I think we could be positively surprised in local Brazil because they're just so attractive. Those yields are just so high. There could be some positive surprise there. And notwithstanding what I said about Turkish local bonds, I actually think Turkey hard currency bonds, maybe not right now. I think that they could be one of the outperformers this year, and it might not, happen till later in the year. The biggest out of consensus view, I think, in EM would be that EMFX is going to do well, and that the dollar will significantly underperform EMFX. That's not my view, but it would be a big out of consensus view. And just positioning, I don't know if you're going to ask about the pain trade, but the biggest pain trade for EMD investors overall, because of how conservatively positioned everyone is that growth ends up being significantly better in the US, in China, maybe even in EM. Inflation really rolls off, and a lot of this stuff just rallies. And we know there's a big imbalance between the buy side and the sell side, and prices are just going to gap up, and that will be incredibly painful.
Thank you so much, Cathy. And Janet, a very good question, from Cathy on could the big surprise be emerging markets FX does well. I mean, your thoughts on, the currencies. Is it a strong dollar year, given where we're at right now and the call on the Fed? But when you think about asset classes, how do you think about, how currencies will do versus credit spreads and other markets, and what the implications are of the macro outlook that we're sitting in right now?
I'm just a mere economist, Joyce, but we are in the strong dollar camp. But I suppose our narrative is probably stronger than our currency forecasts. But it is very much based on the view of Fed normalization and any alternative currencies not moving with them. I suppose within Asia, we think Asia's policy tightening is more aligned with that of the Fed. It's always, it hasn't really begun at all. Whereas in a lot of the other emerging economies, it's already, we've seen a lot of it aggressively over the course of the last 6 to 9 months. So we're not particularly optimistic on the emerging market currencies. But I think Cathy raises a good point in terms of tail risks and where things could actually come from. I do wonder whether there is a possibility in 2022 if the fiscal support in the US does fade, if things were to slow down more materially and the distribution of income means that people sit on such a large amount of their savings, could actually rate expectations get scaled back later in 2022, and indeed China surprise on the upside more significantly. So that would be a bit of a shift, because actually China wouldn't need to tighten its policy at all. It's one of the few economies in the world that does not have an inflation problem at all. It's got producer price inflation, but CPI, as we all know, is on the floor in China and Japan without the producer price inflation. So markets, I'll leave to Cathy.
And I am hearing just more sort of opportunities in China, actually, is also the view that we have at JP Morgan. But Cathy, I wanted to ask you just about the politics. I mean, we heard a bit about the US elections, but you talked about the rise in populism. How are you looking at the political risk in emerging markets and how the election calendar will play? Because it's a pretty heavy election year this coming year. So how are you looking at the political risk?
Yeah, I think it's relatively high, and I think that's one of the reasons why investors are positioned, including myself, positioned the way we are. You alluded to this earlier, Joyce, and maybe you foresaw this. I think the sizing of positions is really key, and that was one of the other big lessons from the pandemic and what happened in the markets post-March 2020, is that we need to be much more mindful and careful. And that doesn't mean that you're not going to have relative value positions on underweights and overweights. But in order to really want to pound the table and have a significant overweight, you have to be pretty sure that you're going to be right, because it's very, very painful otherwise. And I think that it's this dimension of uncertain political risk that makes that really hard to do, given that fundamentals have deteriorated. And if you even take a step back and broaden out the political discussion to a geopolitical one, to that realm, it's pretty dicey here. This week, there are obviously talks taking place between Russia and the US as it pertains to the Ukraine. We know that there's this tension between China and the US, and there's always tension in the Middle East. So I think that geopolitics, kind of writ broadly, are one of the reasons, maybe why we need to have the extra spread that we do have in EM, because there's that uncertainty. The world needs to rethink the power position of the major players, and it's our asset class that kind of feels the aftermath of that. I think more than any other asset class. So I think China's paying very close attention to what's happening with the discussions that Russia's having with the US and how that all plays out. And likewise, countries like Iran are paying very close attention as well.
No, and so, but both of you actually see the opportunities in Brazil, even though it is an election year, it seems. But I know that we are coming very close, on the time right now. But I really wanted to just, thank Cathy and thank Janet so much for sharing all of their insights with us on the international markets. And it does look like we are, could be in for a year where just some of this country differentiation and sort of picking and choosing that, you could really make a difference here, rather than saying there is a way to make more of an aggregated call on this. But just thank you for sharing your thoughts on the opportunities. I'd like to now turn this back over to Erin, and thank Fiazi and all of the sponsors once again for hosting this session.
Great. Thanks, Joyce, and thanks, everyone. So we certainly packed a lot of great information and views into the past 2 hours, and great job, everyone, for staying on time. And we have a lot to consider as we wait to see which direction the economy, the markets, I think most importantly from those discussions where the Fed are going to take in 2022. Thank you to all of our speakers for their time and insights today, including Barbara, Cathy, Priya, Winnie, Janet, Lale, and in particular Joyce, who really helped us with the event from the start. We truly appreciate all of your efforts and guidance. And to Ralph de Cisar for his constant efforts to put forth great content for Fiazi, Laura Nauser for all you do to keep Fiazi running day to day, and to the Fiazi board members for their continued efforts to share our mission. Lastly, I thank you to all of our sponsors of this event, including CreditSights, Fitch Ratings, Moody's, and S&P Global Ratings. We always appreciate your continued support of our organization. We are welcoming new members into Fiazi and encourage you to check out fiazi.org to see all of our events and learn more about us. I ask that you please answer the survey at the end of the session, as we would really appreciate your feedback on today's event. On behalf of Fiazi and our presenters, thank you for joining us today, and enjoy the rest of the week.